Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Want to learn how to make 13.4% interest guaranteed on your money? This is going to be a good one.
Welcome to the Worry-Free Retirement with best-selling author and fiduciary Tony Walker.
If you got it, you don't need it. If you need it, you don't got it. You don't get it, shame on you. Funny, funny, funny what money can do. Them that have it, get more of it. The less they need it, the more they love it. And it sticks to them like glue. Funny, funny, funny what money can do.
With over 10,000 people turning 65 each and every day, the idea of retirement is not only on the minds of those 10,000 people turning 65 every day, but believe it, folks, it is on the mind of hundreds and hundreds, if not thousands, of financial advisors licking their chops to try to help you earn better returns on your 401k. And that's what we'll be talking about today. Well, welcome, folks, to the Worry-Free Retirement. I am Tony Walker, and with us in the Louisville studios as we record this show on April 13th, 2021. As always, producing the show is America's favorite financial sidekick, Mr. Aaron Orander. Good morning, Aaron.
Hey, good morning, sir. How are you?
Doing good, doing good. By the way, appreciate you and Derek coming down to the Bowling Green offices yesterday. We got a lot of good footage for a couple of shows we're working on. Did y'all have a good time?
Yeah, we did. We had a good time. Good to see the new office. Not new office, but the renovated office.
The renovated. Oh, it's awesome, isn't it? And then we also have kind of a surprise guest who's going to be kind of walking along this retirement journey for the next 26 minutes or so. My favorite son-in-law, Mr. Trey Juergens. Good morning, Trey.
Good morning. Thanks for having me.
Oh, you're welcome. As always, appreciate you being on the show. You know, we were talking in our meeting this morning, in this 10,000 figure we're always throwing out there. People probably get tired of hearing if you listen to the show or watch the television show, folks. You always hear me talk about this 10,000 people each and every day turning 65. But it makes sense when you think about it, because if that many people are retiring with trillions of dollars in these 401k plans, it stands to reason if you happen to be one of them, if you're over the age of 55 to 70, that's where the sweet spot is for the financial world, you are going to get bombarded with messages about money and investing your money with these financial institutions and financial advisors, quite frankly, like us, right?
Oh, yeah. Follow the money. That's the financial world is following the money.
That's right. And if you caught the first of the program, I bet I got your attention when I guaranteed 13.4%. Now, let me say something. My compliance officer here at Tony Walker Financial just happens to be my favorite son-in-law, Trey, fellow fiduciary. And if we hadn't have already prepped for this show, you probably would have probably had a heart attack and fell over and died when you heard that.
I about did.
So let's make sure before we get too far in the weeds here. But you know what, though? We're going to clarify this. A lot of people aren't. This is the problem, Trey. So let's set the stage. Yesterday, I had a meeting with one of my current clients who, as you all know, we do things other besides annuities. We're known around the country for our annuity work, and we do a lot of other stuff with Charles Schwab and all that. But really today's show is to focus on these products we call annuities. So I hold in my hand, obviously I'm not going to name the client, came in, he said, Tony, I just want to go over everything. And he said, I want to ask you about this. So again, I know you can't see this through the magic of radio. It's what is this, a 5x10 postcard? Whatever. But you probably get these in the mail. A lot of dinner seminars come this way. So this gentleman got this in the mail. And I'm just going to kind of dissect this. The first thing it says it's time to take control of your retirement. And then down in the bottom right tray, it says guaranteed income annuity payout rates between, and remember, guaranteed, 5.24% and, listen to this, 13.4%. Let me repeat that, folks. You're at home, minding your own business. You go out to check the mail. You get this 5x10 postcard that says it's time to take control of your retirement. Again, as we record this show in April of 2021, you're getting 0.5% at the local bank. Maybe you're a saver and you don't want to risk a bunch of your money in the stock market. So Trey, put yourself in the shoes of a 60-year-old getting ready to retire, and you get this postcard and it says guaranteed. It does say payout rates, which this gentleman didn't know what that meant. We'll get into that in a minute. Guaranteed, 5.2 and 3.4. What is your first thoughts to this postcard?
It sounds too good to be true. And I think that's one of the things savers are looking for. There's got to be something better out there than earning next to nothing at the bank. So you get a postcard and run in, tell your wife you're ready to retire because you're going to get 13% guaranteed.
Yeah, so folks, you have to put on that hat. If it sounds too good to be true, it probably is. But rather than just laughing at this postcard and saying, what in the world, I won't name the gentleman's name. Actually, I've seen this fellow before. He's out of state, but he's very successful in marketing. I know that for a fact. So today on the program today, what we're going to do, we're going to dissect this whole world of annuities, how they find you. This gentleman asked, he goes, wonder how they got my name? You know, how they find you. They know how to find you, folks. The message they're pitching, what is really guaranteed and what is not. How can this person legally put guaranteed on here? And he can do it because he's got disclosures and disclaimers. The reason they know that the reason they're putting these high returns on with their legal disclaimers, which a good compliance officer would make sure they did, is because they know you don't understand what these products are, and you're going to be tantalized by 5.24% and 13.4%. So when I return, we're going to do a deep dive, and we're actually going to just keep focusing on the literature that we have in hand, this postcard, and also talk to you about what to be aware of as you hear of all these people peddling annuities and why you better be real careful and not get stuck in the wrong annuity. I'm Tony Walker. You're listening to The Worry-Free Retirement. We'll be right back. Have you recently retired, been laid off, or offered a pension buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today. Welcome back to the Worry-Free Retirement. If you're just now joining us, we started off today's show with how apparently somebody can get you a guaranteed return of 13.4%. And America's favorite financial sidekick, Aaron, I know you're busy working on something else over there. When I said that, I think, is your neck okay? I mean, it whipped around. You got whiplash. Yeah.
And Tony, I've got a quick question. So if that one company could guarantee that much, why wouldn't all the rest of the companies just be put out of business? How could they guarantee that?
That's a very good question. Trey, you better be careful. I'm going to have Aaron step over here in their shoes.
Stealing my thunder over there.
I'm going to answer that. By the way, Aaron, we were talking earlier. We're having more and more people ask about ways they can listen to this show or even watch the TV show. Real quickly, tell them some other, before we dive into the meat of today's subject, how they can watch previous episodes, not only of the TV show, but listen to previous episodes of the radio show.
Sure, I'd be happy to. So folks, if you've missed a radio show or if you're coming in on this show late and you want to go back and listen to the whole thing, not a problem. All you got to do is log on to SoundCloud.com. Just go to SoundCloud.com, and right there at the top there's a search bar. Just type The Worry-Free Retirement, and you're going to come up on our page. You're going to find all of our past radio shows. Just click to your heart's content, just listen to all past radio shows. Now, if you want to catch the TV show, but, maybe you don't get up that early or you're working and just, have missed it or whatever, feel free to go to YouTube.com and type in Tony Walker Financial. YouTube.com and type in Tony Walker Financial. And you'll see Tony's smiling face right there. Just click on that and you're going to find not only past episodes of The Worry-Free Retirement, you're going to find all types of video content.
All right. Thank you, Aaron. Okay. So Let's first of all start off with the real problem here, Trey. The real problem is, if we go back even really 15 years ago, it wasn't that long ago, here's how easy it was for savers to enjoy their money, okay? You go to the local bank, let's say you got $100,000, you give it to the banker. They give you a 6% CD. That means you get $6,000 a year without even having to touch principal.
Simpler times.
Simpler times, knew what you had, it was guaranteed. Not a lot of thinking. The only thing you had to do when a CD matured is you drove around town and tried to find one paying a little higher. Okay, now here we are in 2021, and we're not going to start bashing the Fed and all that, but my point is, folks, for the saver out there, I'm talking about savers, retirees, not people looking for low home mortgages, rates, and all that. This has been disastrous, what the Fed has done to our dollar and pushing these interest rates so low. So what happens, Trey? We're all human. People get into retirement. They're afraid to risk their money. They're looking for something safe. And again, in case you're just now joining us, you get a postcard in the mail with the word guarantee, by the way. Guarantee payout rates. We'll define those in a minute. That's really a key word, folks. You got to pay attention here. Guaranteed income annuity payout rates between 5.24% and 13.4%. So Trey, let's start off with a couple of things. What's the first thing people should ask themselves when they see payout rate? What is the difference between a payout rate and a yield that you could get down at the bank? So let's try to take a stab at defining a payout rate.
Yeah, so what they're looking for, the saver's looking for percentages. That percentage does not mean the yield. So 13.4% is the amount of payout if they were to start income on this annuity, and it says on there they got to wait 10 years to do it. So at age 70, by age 80, after that 10-year deferral, is when you can even see that 13.4%.
Yeah, so let's use this example. So let's say the bank were paying a guaranteed rate of 13.4%. What Trey's saying, that's a yield. So if we took $100,000, and this gentleman, the annuity peddler that sent this out, has $100,000 to show an example. So if you took $100,000 and in your mind you're getting 13.4%, you would think at the end of the first year you would have roughly $113,000 in that annuity, right? Isn't that what you would think?
That's what you'd think.
But that's not how it works, folks. Here's how they come up with this 13.4%. So what Trey was saying here, and they did provide a chart, and I would say most people have no clue what this chart even means. Oh, here, I'll read this. So if you're riding down the road, tell me, folks, be honest, if you would even know what I'm talking about. It says, this figure, the figure I'm about to read to you, folks, is a percentage of an income value, not an annual interest rate. So we're going to wait a minute. Be honest with yourself. You're probably thinking, I have no idea what you're talking about, Tony. They know you don't know either. So that's why they put that on there. They got to make sure the attorneys and compliance officers are okay, but they know deep down you don't have a clue what annuities are. You don't know what payout rates mean. So off we go. And now we go to the chart, and there's that 13.4, Trey. Again, where are your eyes going to go?
That big number.
Big number. It looks good. It's like those, it's like a steak dinner, man. It looks and sounds good. I'm going to dig in. So let's try to walk through. I know this is a radio show. Bear with me. How they're calculating that. So what they're assuming here, that someone, to get the 13.4, you got to ask yourself, how am I going to get that? It's not a yield. It's not like a bank CD. How do they come up with that number? So in this case, what this gentleman calculated, we'll talk about the company they're using in a minute. We won't name the company, but they do quote the company. This even gets more laughable, this whole thing, as we go further into this. At age 70, if you give this insurance company $100,000, all right, and if you wait 10 years, in other words, you can't have access to it, you're going to wait till you're age 80. First of all, is there any guarantee you're going to be alive at age 80?
There isn't.
No, I know in my Live Well, Die Broke book, I'm predicting I'll die at 79, so I'd have no interest in this. So I'm really interested to know how they're going to guarantee me 13.4 if I wait to take the money out at 80, if I'm dead and gone by 79. This is really going to fall apart. But let's keep walking with this example. So in this little chart on this postcard mailer, it says if you wait till 80, they're going to pay you $13,407 a year for the rest of your life. That's not bad, is it? I mean,
no.
Okay. All right. That's, Trey, where they're getting the 13.4%. And you might say, well, yeah, Tony, that is right. No, you got to stay with me, folks. This is where it gets really, really, to just be able to show this, quite frankly, is just so unethical, because nobody's going to understand this unless you have a background in annuities like we do. Okay, so let's stay with that. So let's say I do live to age 80. I've got this annuity, Trey. You with me?
I'm with you.
Okay. And I call the insurance company. You might as well, I've never heard of them. We'll say Mutual of Nairobi. And I call Mutual of Nairobi and say, okay, I want my income, my lifetime income. This is a lifetime income annuity. Are you going to guarantee me $13,407 a year, assuming this company's still in business? The answer is yes. That's the contract. That's the beauty of an annuity. I like that. Okay. So they start paying me my $13,407. Remember, folks, that's where this interest rate is coming from. That's called a payout rate. That is not a yield, folks. Please, this is not like leaving your $100,000 at the bank and they're paying you $13,407. This is an insurance contract. This is not a yield. And you're going to find out why this thing falls apart real quick. So let's say the first year I get my $13,407. The next year, Trey, I die. What happens?
That goes away. Nobody gets to see that 13%.
It's gone. So you have to look at these annuity contracts very, very closely, folks, right now. And it's not just this company. We're seeing this all over the place. I know you did some perusing on the internet, didn't you? I mean, there's all kinds of, if you look at those little box ads that pop up, guaranteed 7%, guaranteed 8%. We'll get into bonuses in a second. Folks, these are called payout rates, and you better understand what a payout rate is. Now, again, a payout rate on an annuity can be useful, and we recommend these products in some cases, but you have to have a game plan in place to get the annuity. In fact, this postcard says, we'll compare hundreds of annuities for you in just minutes. See, they're just breaking this down to a product peddler deal. Doesn't even mean if we find the right annuity paying the highest amount for you is going to be the best annuity for you, unless you have a game plan. So the first problem is there's no game plan. I don't know, even if you had these people search annuities, what are you going to do with it? How do you know which annuity is right for you? And then the second thing is you're led to believe that you are actually going to make 13.4% on this annuity from a yield standpoint, and you are not. It is not the same thing. So when we come back, we're going to dive into who is the company behind this, who is the agent or agents behind these types of mailings, and what are you going to get if you get suckered into something like this? I'm Tony Walker. You're listening to The Worry-Free Retirement. I'll be right back. With the stock market at all-time highs and our nation's debt through the roof, there's a lot of uncertainty out there. Now may be the best time to safeguard more of your 401k. Let's get started today by logging on to TonyWalkerFinancial.com. It is estimated that each day over 10,000 people will turn 65, which means a lot of advisors selling a lot of annuities. Don't get stuck in the wrong annuity. Get a second opinion from TonyWalkerFinancial.com. Welcome back to the Worry-Free Retirement. Me and Trey in the break I actually referred to this, I'm just getting fed up with this stuff. How many times, Trey, you're seeing more and more people as a fiduciary? We see a lot of people, but I'd say over the last month, you're seeing more and more people. I mean, don't exaggerate, seriously. On average, how many people within the course of a month come to us who have purchased an annuity, have no clue what they've got, and unfortunately, as we like to say, in many cases, they're stuck in the annuity. What do you see out there? Because you're seeing a lot of people.
We probably see 10 a month come in with an annuity that they're stuck in. They were sold it. They might have understood some of it at one point, but now they're coming in making up different numbers and names for what the original advisor called it, and they just really have no idea what they've got, and they're stuck in a long surrender period that they just obviously can't get out of. So we're trying to help make sense of it and fit it into a game plan now, working backwards, because they started with a product, not with a process.
Yep.
And it is frustrating. I mean, like we were laughing at the break, it just there's mailers going out, there's steak dinners where these annuities are being sold with not enough explanation of what savers are getting into.
And again, folks, you'll have to understand, we love annuities. In fact, I've got a great little booklet on our website at TonyWalkerFinancial.com. It's a download. It's called Annuities Made Easy. So let me make sure you understand, if you're a saver, more concerned about the return of your money than on it, annuities can be great products. But folks, one reason people are spending thousands and thousands of dollars on these free dinner seminars and these postcards, there's a lot of money goes into these postcards. You mail out 10,000 of these, it ain't cheap. Because there's so much money to be made in the sale of annuities. Now, this company, and I'm not going to give the name of it. We're going to call them Mutual of Nairobi. We looked up this company. This company is a B++ by AM Best. By the way, as a fiduciary, we don't ever represent a company that has a rating that low. That just means good under AM Best. I'd rather have excellent. Okay. So first of all, we got to ask, so why would this agent who's not even from this area, and we'll talk about how these agents, marketing firms are working right now, why would he use a company that's a B++ company? Why is that, Trey?
They're going to pay a higher commission.
Bingo.
And if this guy's 2,000 miles away mailing out flyers to generate leads for agents that he's splitting commissions with, he wants a bigger piece of the pie to be able to share.
Bingo. So here's a rule of thumb, and we've learned this from working with insurance companies. Now, we represent a lot of different insurance companies because some of them have better products and different types of annuities, and our job is to figure out which of those annuities fit the person's situation. I think last year we did over 50 million of annuities easy, and I think we had 7 different companies, and they were actually pretty even, weren't they? That was kind of weird how that worked, and we saw a breakdown at the end of the year. Now, we didn't try to do that. We just found the products that suited, but I think they were fairly even. I think we had a couple that were a little higher, but that's pretty good.
No, it was really neat to see because I know Heather does a lot of research in these products, and fitting them into the specific saver situation is really important.
Yeah. So I was real proud of that, actually. So as fiduciaries, we're not, we have to know what the commissions are, but I couldn't even tell you with, I think, 4 of those companies that we've taken on this past year, I know the percentages kind of, but not really, And so what happens, folks, is, so let's take this company, Mutual of Nairobi, in this example. This gentleman has agents all over the country peddling this particular product, right? Yep. Okay. So that means there's no telling how many millions and millions of dollars of premiums are flowing into this company. So what happens, folks, you have to understand there's incentives, there's overrides that insurance companies will pay if you hit certain marks. It's like any business. The more volume you write, the more you get paid. Well, you got to think of the potential conflict of interest. So we find a company that's not well rated, that pays a huge commission because they know they're going to have to pay a huge commission to get people to put money with them. And then this person has these agents all over the country following up on this postcard. So I won't even name the state where this one came from. Let's just say it came from Nevada, okay? Mm-hmm. So let's say this person is located in Nevada, but you get the postcard in Louisville and you get a call from a local guy right here in Louisville, and you're like, hey, that's pretty cool. But the postcard says it came from Nevada. What's your relationship? A lot of times they won't tell you, but here's what happens. So the guy in Nevada goes to all these agents and says, hey, how's your business? And the guy in Louisville, let's say, or wherever he is, says, it's not doing too well. How about if I can get you in front of 20 people this month, and I'm going to set the table for you, and you're going to be able to walk in and sell an annuity and make a big commission. How's that sound to you? What do you think they're going to say?
Heck yeah.
Sign me up. So what happens is the person in Nevada gets about half the commission. They're making a lot of money on this. They pay an agent that maybe is not doing as well financially because the agent needs leads or prospects, so they're willing to give up some commission. But you have to have a company sometimes like this because now you got 2 people that need to get the commission. So sometimes the Mutual of Nairobis of the world will pay a higher commission. So folks, the whole point of this exercise and going through this is realizing this is not bent around your needs. This is a marketing ploy to sell a bunch of annuities. Now, again, if you're just now joining us, we don't have a problem with annuities. What we have a problem with is some of these tactics out there and enticing you to buy an annuity based on rates that are not guaranteed in terms of yields. We have to understand the difference. One more thing I want to go over here, this is kind of interesting, Trey, is something also, and again, we have products that pay bonuses, but these bonuses are also very enticing. So at the top, in case you're just joining us, folks, what we had was a gentleman, client of mine, that came in, and he has a Schwab account, and he has an annuity, he has a lot of things with us, but he wanted me to look at this postcard. So he, out of the blue, had received a retirement planning postcard with a guaranteed annuity income payout rate, which he didn't know what that meant, between 5.24% and 13%. That's where we are if you're just now joining us. Also, what he noticed on there, he said, Tony, that annuity I took out from you several years ago didn't get a bonus. This one pays an 8% bonus on top of all these rates. So again, Trey, let me read what it says. Receive an 8% bonus on your first year premium payment with our guaranteed income annuity. So again, you walk out to the mailbox, you're getting ready to retire, you're tired of 0.5% at the bank, you're afraid the stock market's going to crash, you don't want to do that, you're looking for higher yields. So not only could you make 13.4% guaranteed, even though it says payout, you don't know what that means, but you could also get an 8% bonus on your money. Where are you now in this deal?
Free money. This is great.
Sign me up. So folks, here's the basics with an annuity you have to understand. Let's go through some basics. Most insurance companies, for the most part, are investing their money, the money you give them, the premiums you give them, into the same type of products. Now, what are those products that most insurance companies have to invest in? Well, first of all, insurance companies have to keep your money pretty safe. They're not out investing your money in the stock market, okay? People think, well, they're in the stock market, or I got one of these indexed annuities, Tony. That's not what they're investing in. Most of the insurance companies are investing in either high rated corporate bonds. They usually invest a portion of their money in government bonds, which are very safe. They usually try to invest in pretty safe mortgage-backed securities, okay? And then you say, well, Tony, if they're doing all that, how come some of these companies don't have better ratings? Like this company we're fictitiously calling Mutual of Nairobi. Why do they only have a B++ good rating? Why are they not excellent? Well, therein lies the problem. Insurance companies also have to make sure that those bonds they have are highly rated. Trey, it reminds me as I think about this. I've been doing this now over 37 years. Back in I think it was the late 80s, there was a company back there called Executive Life. They went under. Now, at the time, their dividends were out the wazoo, and nobody thought to check the quality of their bonds. They were investing in something heavily called junk bonds. Mm-hmm. So they were making tons of money, and they were passing that on. Everybody was happy until the bond market collapsed, and then everybody lost their money. So, folks, you have to be very cognizant of the fact that some of these insurance companies out there do not always have their money invested safely. In fact, many of them are out there, especially they're trying to find higher yields too, Trey. This is a little bit of a dilemma for a lot of insurance companies. They're out there investing in things that for the first time I would say are kind of a little risky. Now, they may be called bonds, but you can actually look up, you can go to AM Best. That's the main company that kind of keeps up with the actual bond portfolios of these insurance companies if you want to take the time to do it. They'll tell you how their bonds are rated, whether there's a lot of junk bonds or if they've got a lot of mortgages in default. All that stuff will be laid out for you. The second thing to be concerned about is the amount of reserves that the insurance companies put back. And I know we're getting technical here, but you have to understand there's a reason these ratings come out from these insurance companies, and there's a reason that we will not, at Tony Walker Financial, I don't care what kind of bonuses they're paying, I don't care what kind of payouts they're paying, and we have a bunch of those people approach us, don't we?
Oh, yeah.
We get these same things soliciting us.
Yep.
How come you're not selling XYZ? Well, your ratings. And that's, so the ratings a lot of times reflect the assets and the reserves backing that insurance company. So with that said, here's my thoughts, folks, as we kind of close out this show. First of all, if you are a saver, if you're not somebody that likes to take a lot of risk, maybe take some risk, we can handle both. We are uniquely equipped to do something for our clients called the split IRA concept. Now, here's how this works. We can invest some of your money in our Charles Schwab platform, just like your 401k. If you want some stocks, bonds, and mutual fund, if you want a lot of liquidity, if you want a local retirement planning firm, not one located in Nevada or hiring agents that you never know if they're even going to be in business next week. If you want a local retirement firm with the experience to help you, we can do that. And obviously, we have a lot of working knowledge of annuities. So here's what I would say. If you're getting ready to consider buying an annuity, thinking about one, been to a dinner seminar, get a postcard like this, please, before you do anything, contact us at TonyWalkerFinancial.com, TonyWalkerFinancial.com. Click on that Let's Get Started or give us a call at 877-499-9255. That's 877-499-WALK. Well, that's all the time we have today. Trey, thank you so much for joining us. It's been a pleasure.
Yeah, thank you.
Okay, we'll look forward to seeing you soon. And you, in the meantime, between now and then, if all else fails, you be worry-free.
If you got it, you don't need it. If you need it, you don't got it. You don't get it, shame on you. Funny, funny, funny what money can do.